So it is December 29th, 2010. This is your stock market year-end review for 2010 and forecast for 2011. We're excited about it. Gives us an opportunity to kind of look at what we had right in the market and really look at our foolishness as far as the predictions of years past and where we made some errors. So we'll look at how we traded over the past year, what sectors were our focus, and kind of how our expectations or predictions played out. InvestView is a division of Global Investor Services. We are a publicly traded company. Everything we present is educational and instructive, not to be construed as investment advice, as we don't know your personal objectives, financial situation, or particular needs. So everything we present here is just to be intended as educational and instructive. Please make sure it fits your profile and your expectations for markets if you're going to act upon any of the things discussed today. Here's what we're going to cover. We'll first go through a quick little understanding taxes. We'll get to economics, past, present, and future, year-end review, forecast. We'll look at charts. We'll look at fundamentals. We're going to look at a number of different things. We'll post our major price target and expectations for the next year, and then implement some strategies with real-time analysis. There's also going to be a checklist available along with the recording and the downloadable slide. So we will email those things out to you by Friday. Expect them to hit your inbox. Generally, we also make a link for the recording as well, but we'll make that available for you. So hold tight until Friday, call it Friday evening, and you should be seeing that probably Friday during the day. It does take our programmers a little time to get everything up to speed. Now, let's first start with understanding taxes. We'll go through this pretty quickly. First and foremost, a reminder to you that every country is different and every circumstance is different. So if you are looking for tax advice, you really need to go to an accountant, and you need to get with someone who is familiar with trading in the stock and option space. It's not too complicated, but we don't want this to be your advice and acting upon it. At the end of the year, the Internal Revenue Service reminds taxpayers that you can use losses and you have to pay tax on gains. Generally, realized capital losses are first offset against gains. Then any losses you have beyond that could be used against ordinary income, depending upon your filing status. Losses in excess of this limit can be carried forward into later years to reduce capital gains. These are shown on Form 1040. Now, classified as either short-term if the asset was held less than 1 year, or long-term if it was held more than 1 year. Some of you are day trading E-minis. E-minis, futures contracts, have a little different taxation. They're part short-term, part long-term, even if you're day trading them. So once again, do your own homework, but the nice thing about that is if you day traded E-minis, you've got a nice profit. Even though you were day trading, you get to use some of that as a long-term capital gain and a lower taxation. Now, there are two categories, capital gains and losses. In the event of a net gain, a net capital loss resulting from either category is directly deductible from ordinary income up to the annual limit. This often works to taxpayers' advantage if you have losses, because you can use it against your ordinary income. For example, if you're in the 27% tax bracket, you had a long-term gain on stocks of $2,000, the tax due would be 20% capital gains rate for a total of $400 on your profit. Taxpayer B, who's also in the 27% bracket, had a net long-term capital loss of $2,000. The corresponding tax savings would be calculated at the individual's ordinary rate of 27% for a $540 reduction in taxes. And that's how it can work to your benefit against ordinary income. So important, a drop in an investment's value below its purchase price, known as a paper loss, does not qualify for a tax deduction until it's actually realized through the investment sale. And another important point is they've changed the taxation going forward. So as of 2011, not only will your broker send you at the end of the year everything you sold, your job is to report everything you sold and whether you made money or lost money on each of those. They're also going to be required to provide where you bought the stock, where you bought the asset. and they have to transfer that forward to other brokerages. So it's going to make it very easy and simple, because they'll give you your gain, they'll give you your loss, and it's going to be nice and easy for you to do your taxes 2011 and beyond. Keep track of any positions that you hold into the following year. Holding, for example, from 2010 into 2011. Say, for example, we bought some shares of various stocks. You'd want to keep track of that. Your broker should send you an end-of-year form, 1099, which will list all the investments that you sold, along with the cost basis starting in 2011. But anything you bought in 2010 or 2009, you have to kind of dig up that cost basis yourself. So we always say it's important that if you hold a position into the next year, you pay attention to that. It won't matter in the future years, obviously. Refer to irs.gov or a tax advisor for assistance. Please refer to this website if you're in Canada. We have a lot of Canadian members, so here's the website or a tax advisor for assistance. Report gains or losses in Canadian dollars, capital losses under Schedule 3 if you're up in Canada. So again, these slides will be downloadable if you want to review them, and they should not be construed as tax advice. If there's anything I'm not qualified to give, it's certainly tax advice. So let's jump on to the next topic here. If you do have questions, you can type those in to the chat box. We'll try to answer all of those as best we can. If there are questions that are left unanswered by the time we're done, then you can also email us as well. We're going to look at economics, past, present, and future. Really, let's get taxes out of the way. Those are not exciting for anyone. Let's move on to something a little more exciting. Here are really kind of the investing fads that we've seen over the past 14 years. So I thought it was interesting to kind of look back and say, well, what do we think were the major drivers of the stock market in each year? In '96, initial public offerings. Irrational exuberance, right? The Federal Reserve, Alan Greenspan, his famous talk about irrational exuberance. In '97, Viagra and cigars. I suppose those were the good old days where you could sit back and take your Viagra and smoke your cigar. '98, email, venture capital. '99, internet and Y2K. Tracking stocks, which are the holder ETFs, became very famous during that period of time. SMH, OIH, PPH, RTH, and so forth. Different style of ETF. They're a little outdated at this point in time. Year 2000, we had wireless. And 2001, well, Warren Buffett was back in vogue. The market tanked. Technology companies went bust. The bubble burst on Techland. And old economy, old defensive stocks won out. So he didn't chase into the technology euphoria. He's certainly been wise in many different bubble scenarios. One that he didn't really see coming, however, was the housing bubble, and a lot that had to do with that. 2002, security technology, defense companies. 2003, biotech. 2004, voice over internet. China really started to grow. 2005, oil and home builders. Residential real estate in 2006, private equity and hedge funds, and the BRIC nations, Brazil, Russia, India, China, commercial real estate. Obviously, that was the end of that. We had the bubble burst on the real estate fund to a certain extent, and away we went to the downside. In 2008, it was gold and leveraged ETFs. 2009, the emerging markets and commodities. 2010, miners, metals, and mobile web. So the question you have to ask now is, what's it going to be in 2011? What are the key points? What are the things that are going to be in vogue next year? And those we need to figure out, and those we need to take advantage of. Our initial instinct is 2011 is going to be the year of food prices, of specifically agriculture. So when we come back next year and we add another column here, it's probably going to say 2011, agriculture, potash, mosaic, deer, rising food prices, rising prices on a lot of different things, grains, corn, you get the idea. So that's our initial instinct.